Now, I want to stress something. IOUs were initially great for us because they made money better. They made gold better. They made gold more space saleable. They made gold more scale saleable. And as we've talked about before, any efficiency gains we get from money for an improvement on money translates to higher productivity for us. So IOUs were great for us because they really improved on money on these two planes. And they didn't really have any downsides. So if we take a look at an example where we have a specific productive capacity, goods and services available. Now we're a little bit into the future, so we replace the horses by cars, telephones, light bulbs. There's a specific amount of goods and services available in the economy. And we have a specific amount of gold circulating in the economy. Now here, if you had one gold coin, you would have a 10% claim on the total productive capacity available. Now what happens if you put your gold coin with a goldsmith, store it there, and the goldsmith issues you an IOU and gives you that IOU. Now you have an IOU instead of your gold coin. Well, you still have 10% claim on these goods and services, right? And that IOU, because it's transferable, people would accept it from you because they know they can come back to the goldsmith and get the gold coin if they have that IOU, right? And most people would want to accept it because of the benefits of an IOU. A lot of people want to use IOUs instead of actual gold because it's just easier. When you have that IOU, it still gives you the same claim. Notice here, that goldsmith isn't using your money. He's storing it for you. So he has a reserve ratio of 100%. If he has your gold, he's keeping your gold. It's like a safety deposit box. It's just in the safe. He's not using it. And the money supply is still 10. It didn't increase. And this is a situation where IOUs were great because you have an IOU, your gold is safe somewhere, not being used. The money supply didn't increase, and you or whoever has that IOU can always come back, give the IOU to the goldsmith, take back the gold coin, and the goldsmith would tear up and throw away this IOU because somebody claimed the gold. And that's it. So you can see how IOUs really improve on money without breaking anything, because having introduction of IOUs, when IOUs are backed by gold or the gold is stored somewhere, 1-to-1, doesn't cause an increase in money supply, doesn't cause any issues, just improves on money. Now, these proto-banks also offered lending services. Now, we're saying proto-banks because they're not like the banks we know today. Now, borrowing, lending, has existed for a very long time, for thousands of years. You can borrow in different types of money. You can borrow in wheat, and you can pay back in something else. If you're a farmer and you're harvesting your crop, you can have an agreement where you're paying back in livestock. Borrowing and lending is an agreement between two individuals where one is taking on risks and lending the money to somebody else, and in return, they gain interest if that person succeeds in what they're doing. So that existed for a very long time. Now, individuals didn't borrow in the same way we borrow today, where everybody's borrowing today. We're going to talk about that later on. But back in the days, if you had something and you needed some funds, you could borrow. And some institutions, like goldsmiths or these prototypes of banks, who had somebody storing funds with them, could ask that individual if they wanted to lend this money out. And what they would do is they could lend it out to somebody, do the work required to make sure that this is a safe type of investments, and lend that money to somebody else. Now here, this borrowing and lending is between two individuals. One person lent it to somebody else. And this goldsmith only facilitated that transaction. If one individual ends up losing that money, then the risk is only on the one who lent it. Then they would have lost it. And if the person is able to pay it back, well, there's going to be some gains where the person who lent it gains some interest, and the facilitator of that transaction makes a fee. But for you as an individual, it didn't affect you at all. You still have your 10% claim. It doesn't matter if somebody borrowed or lent, if they lost it or if they didn't lose it, you're not affected by it. Your money is still worth the same, which is a 10% claim. It didn't get diluted. The money supply didn't change. Now, the problem started when these proto banks started lending money that they didn't actually have. So how did they do this? Well, let's take a look at a situation where you had one gold coin and you went to your local proto bank, deposited that coin, and got an IOU instead. Now, you use this IOU to transact. And when you bought something with it, the person receiving it wasn't that likely to actually redeem the IOU for the gold. They would just use the IOU as well because they knew it's as good as gold. They can redeem it whenever they want, but it's just easier and more practical to use the IOU. So the IOU would just circulate in the economy as if it was gold. People knew this institution, where it came from. This IOU had the name on it, and they trusted that they had the gold, so they just kept using the IOU. There's no reason to redeem it. And as more and more people did that, where they placed their gold at their local proto bank and got IOUs to use instead. And as more and more people did that, more and more of the circulating money supply became these IOUs because it's just easier to use. And these proto banks came up with the great idea or the realization of, hey, very few of these people are redeeming their IOUs for gold, not at the same time anyways. So you know what we could do? If somebody wants to borrow some funds, instead of facilitating that transaction between a lender and borrower, where one party takes on the risk for potential rewards, we'll lend them the money. We'll create an IOU and give them the money if they want to borrow funds. And at the end, when they pay us back with this IOU plus interest, we'll take the IOU, we'll put it in the trash because it's not backed up by anything anyways, and we'll profit from that interest. So now they've issued an IOU that isn't backed up by anything. They just wrote, this is an IOU, here, we'll lend you the money, but they just created it. It wasn't backed up by anything. When they created these IOUs, they took a gold to issue it. So it's backed up by a piece of gold. But this one isn't backed up by anything. They just created out of thin air. Now, maybe you can say, well, when the person pays it back, they'll put it in the trash and no harm, no foul. But that never happened. Because if they can make money by lending money that they don't have, why would they stop? It's going to be a continual process and they'll make more and more of it. Now, what are the issues of this additional unit here in the money supply? Well, now the money supply is bigger. There was debasement. Your claim was now reduced because now you have one IOU over 11 units instead of one IOU over 10 units. So your claim got reduced. There's price inflation. Things are more expensive because there's more money. So these proto banks started debasing the money because they can issue units and nobody could know that, hey, they issued a unit that isn't actually backed up. Now, the problem here is now they don't have enough gold to back up these units. The reserve ratio drops to 83%. Let's say the person who borrowed this unit spent it. Now there's 6 people who have these IOUs. If these 6 people came and wanted to exchange their IOUs for the actual gold, this proto bank doesn't have as much gold. There's 6 units of IOUs, but there's only 5 units of gold. They only have 83% of the issued IOUs. The reserve ratio is lower than 100%. So you can see the issue here, right? Now, what's the odds of everybody, claiming, redeeming their IOUs? Very low. So they just keep doing that. They issue more IOUs. And again, here you see that it's not proto banking anymore. It's banking because this is the banking system we have now. It's fractional reserve banking, which means they're allowed to keep only a fraction of their reserves that they're lending out. Okay, they don't need to have 100% reserve ratio. This is what we have today. Okay, so as they issue more and more units, the money supply grows. There's inflation. Money is debased. Your claim is reduced. Their reserve ratio is going down. And this process continues. More money. Your claim is lower. Reserve ratio is lower. And you can see the issue here, right? Well, we already know the impacts of debasement and inflation. But there's also another issue, is that people start realizing, hey, I have an IOU from this bank. You have an IOU from this bank too. Oh man, there's so many of these IOUs from the bank. There's so much money around here. Prices are going up. Hey, does this bank even have that much money? Because again, the IOUs are currency. The money is the gold, right? Then you start stressing. You're like, hey, I have a bunch of these IOUs. Everybody's having so many of these IOUs, all from this same local bank here. How come there's so much? I don't know if they have that much gold. And you're scared about your money. And this is what we call bank runs. People realize this. There's so many IOUs out there. And they're scared that they wouldn't be able to redeem the IOUs for gold because this bank doesn't have as much gold. And these IOUs aren't the money. The money is the gold. The IOUs are just pieces of paper that says they can be claimed for gold. They're a layer 2 solution where we have to trust the issuing centralized institution that they do have that gold. So people come up and say, hey, we want to redeem our IOUs all at the same time. And the bank manager comes out and says, oops, sorry. This is the bank runs we've seen, right? Where people realize that, hey, the bank doesn't have all the money. We got to get it. And why are they called bank runs? Because let's say you realize that, hey, this bank has a 90% reserve ratio. They have 90% of the money, but there's 10% missing. You're going to go get your money right away. You're going to run to the bank because the 90% of people who show up first are going to get 100% of their money. But the last 10% of people, there's not going to be any money left. They're going to get 0% of their money. So even if you think there's 1% of the money that isn't at the bank, you're going to run to get your money. That's how bank runs happen. People get stressed because nobody wants to be the last person. Now, this type of things caused a lot of issues because initially, when these banks created so many more units of money, it caused inflation. It wasn't good for the economy. And then when people ran to get their money and the bank didn't have that money, well, it causes recessions and issues in the market. So, and this is something that happens even today. Like we've seen this in 2008, which we're going to talk about later. But we've even seen this last year with Silicon Valley Bank. And bank runs now, they're not even bank runs, they're bank sprints. With Silicon Valley, the bank run happened in hours because somebody tweeted about it. Hey, this bank doesn't have all the money. And people now could take out their money online. They don't need to go Monday morning to take out their money. They could do it online. And I think people took out 20% of the deposits in 2 hours. So now it's like bank sprints, not even bank runs. Now you can see all the issues that this creates of bankers creating money out of thin air and increasing the money supply. So obviously there needs to be some regulations or state interventions for them not to be able to do that. So now we have the state that steps in and says, you bankers, you can't just run wild like this. We can't let you guys just create money out of thin air and, create all this inflation and then the inevitable recessions that come after it. We can't let you guys do this. Like we got to regulate you. So there's this creation of central banks across the globe. Every country creates their own central bank to regulate the financial institutions, the banks that are there. So in the United States, for example, the central bank is the Federal Reserve, created in 1913. And they come in and they say, okay, well, we have to do some things to have better monetary stability, better banking supervision. So we're going to start off by doing this. We are going to take all these IOUs that you banks have created, because now there's IOUs from different banks. So there's so many different IOUs. That doesn't work. We're going to issue one type of IOU that everybody uses, these paper currencies. And there's going to be written on them, the Federal Bank Reserve. We're the ones who are going to issue them. So if you look at today's money, if you live in the United States and you take a $100 bill, it's going to say the Federal Reserve banknotes. So that's when they were issued in 1913. So that's the initial creation of the money we're using today. Now we're going to replace all these IOUs by these Federal Reserve notes. So everybody has the same unit. It's easier. And new banks that are always out of money here, we're going to take the gold. We're the ones who are going to keep the gold. And you guys use our banknotes and reserves. Now we're going to have better monetary stability. We're going to supervise you. We're going to tell you what your reserve ratios are allowed to be. So you cannot create too many units. Now you would think that the rules are going to be that you cannot create any units at all, right? You cannot create any units more than you have in reserves. But no, it was, we're going to regulate you. You can still lend out more than you have. But if there's a bank run and people are running to take out their money, we're going to be a lender of last resort. We're going to lend you that money. Okay. So we're going to make it that there's less fear in the economy. People are less going to be fearful that there's going to be a bank run, because if there is a bank run, it's okay. As the Federal Reserve, we're going to lend them some money. So your money is safe. There is going to be enough money there. And also we're going to be a government fiscal agent, which means being the banker of the money, managing their accounts and facilitating government funding, for example. Now we're going to talk more about this later on. But for now, when you take a look at all these institutions, these central banks that are propping up worldwide, their objective is to manage all these issues created by these banks and the increase of money supply, all these boom and bust cycles and recessions. But you quickly realize that that doesn't really happen. When you look at the quantity of base money to broad money, it's not really changing. Now here we're going to differentiate between base money and broad money. Base money is, the money kept in reserves. It's the actual money. Broad money is the money created by banks through lending. They're creating more units of currency than there actually is of base money. Now, you would think when these institutions come in, they're going to regulate that and banks are going to create less money. But the opposite actually happens, because as a banker, when you lent out and you created units of money that you issued, you always had to be fearful of bank runs. And if you use a unit from a specific bank, you have to make your due diligence about this bank. Make sure they didn't create too many, because if there's a bank run, your issue, your IOU is going to be worthless. Now that relationship was broken because now there's a lender of last resort, where the banker doesn't need to be fearful of creating too many units of money, because if there's a bank run, hey, he has a lender of last resort. The Federal Reserve, the central bank, is going to create some more paper, give it to him, and he's going to be able to give it to anybody who wants money right now. And as a user of the currency, well, you don't need to do so much due diligence on any specific bank, because you know that they have a lender of last resort. And if you go to get your money, you'll be able to get your money. So it actually facilitates and enables banks to even create more broad money and create more units of money. And all it really did is capture money from all these other participants and put them in the hand of the state, or let's say of the central banks.